For a quarter of a century, the most powerful governments on Earth promised the world a fixed price for gold. They put it in writing, they backed it with the dollar, and they defended it with the full weight of their treasuries. And then, one drain at a time, they lost the ability to keep that promise. The metal walked out the door, the peg cracked, and a whole managed system came apart. That is not a fable. That is the post-war monetary order, the thing they called Bretton Woods, and it fell for one reason that matters to you today. So let me answer the question in the title right away, because it deserves a straight answer. Yes, gold savers are being pressed from two sides at once. That part is real, and if it has your stomach in a knot, I understand the feeling. But here is the honest read, the one the financial channels will not frame for you. The squeeze you are watching is not a squeeze on you. It is a squeeze on a managed price. It is the exact same vice that closed on Bretton Woods. And when that vice closed the last time, it did not crush the savers who held the metal. It crushed the people trying to hold the price down. Here is the concrete piece to chew on before we go any further. Under that old system, 8 nations formed a pool and spent their own reserves day after day just to keep gold pinned at one fixed level. Think about that. 8 governments working together, throwing real metal at the market to stop a price from rising. That is not what strength looks like. That is what it looks like when a dam is straining against the water behind it, and the water always wins in the end. Let me walk you through how that vice actually works, because once you see the two jaws, you will see them everywhere in today's market. In my years around the gold and silver world, I have learned that a managed price is always caught between two forces pulling in opposite directions. On one side, the true value of the metal keeps rising because the money it is measured in keeps getting printed and diluted. On the other side, the authorities keep trying to hold the price still, and to do that, they have to keep handing over real metal. So the value pushes up while the ability to suppress it drains away. Rising pressure, falling defense. That is the squeeze. And a squeeze like that has only one exit. After the Second World War, the world rebuilt its money around a promise. The dollar would be as good as gold, convertible at a fixed rate, and every other currency would anchor to that dollar. For a while, it worked beautifully. But nations do what nations do. Deficits grew. More dollars went out into the world than there was metal in the vault to back them, and the sharpest players noticed the gap. They started bringing their paper dollars to the window and asking for the gold those dollars supposedly represented. The vault started to empty. That is when the pool I mentioned went to war with the market. 8 countries pooled their reserves and sold gold into every rally, trying to convince the world that the fixed price was permanent, that nothing was wrong, that they had it all under control. For a few years, the illusion held, and then it did not. The selling could not keep up with the buying. The defenders ran out of ammunition, folded their hand, and walked away from the price they had sworn to defend. Not long after, an American president stepped up to a microphone and closed the gold window entirely, calling it a temporary measure. It was never reversed. Temporary is still going. Now, let me bring this home, because a story about central bankers in the 1960s can feel very far from your kitchen table. Picture a retired nurse in Missouri. She spent 40 years on her feet, taking the hard shifts, putting a little away in a retirement account every single pay period. She did everything they told her to do. She was careful, she was patient, she trusted the system to keep the value of her savings intact. And now, in retirement, she watches the number in her account and quietly wonders why it buys so much less than it did a decade ago. Nobody defrauded her. Nothing crashed. Her money was simply diluted, slowly, while she was looking the other way. She is on the wrong side of the same vice that broke Bretton Woods, and no one ever sent her a warning. And here is where I want you to get a little bit angry, honestly, because you should. There is a whole apparatus that profits from you not understanding this. The big banks, the trading desks, the financial media that never once explained to that nurse what was happening to her savings. A managed price is a wonderful thing if you are the one managing it. You get to buy the metal quietly while telling everyone else it is a relic, a rock that pays no interest, a barbarous thing your grandparents worried about. They are not confused. They are positioned, and they would very much prefer you stay confused a while longer. So let us look at the first jaw of today's vice, the side where real value keeps rising. The central banks of the world, The same institutions that manage the money have been buying gold hand over fist. For 3 years running, they took in more than 1,000 tons a year, roughly double what they were buying the decade before. That pace has cooled off some lately. It comes and goes, but the direction of travel could not be clearer. And here is the tell that should stop you cold. Gold used to fall whenever real interest rates rose. That was the textbook rule for decades. Lately, that rule broke. The metal climbed even as those rates stayed high, because a price-insensitive buyer, a central bank protecting itself, does not care what the interest rate math says. When the people who run the money are quietly stacking the metal, the value side of the vice is doing exactly what it did before Bretton Woods broke. Now the second jaw, the side where the ability to hold the price down keeps draining away. This is the part almost nobody explains to you. In the modern market, far more paper claims on gold and silver trade every day than there is deliverable metal to satisfy them. The registered inventories that back the futures exchange have been drawn down. The free-floating metal in the big London vaults has thinned out, and a small handful of large banks carry concentrated short positions, promising to deliver metal they would struggle to produce all at once. It is the London gold pool all over again, just dressed in modern clothes. As long as most people are happy holding paper promises, the game runs fine. The moment they start asking for the real thing, the defenders run short of ammunition. Same movie, same ending. And that is exactly the point where I want to talk to you directly, because if you have been feeling that pressure, there is something concrete you can actually do about it. One of the widest tells in this whole market is the ratio between gold and silver, the number of ounces of silver it takes to buy a single ounce of gold. It has been stretched historically wide, and when it is stretched like that, it has a long history of snapping back and rewarding the people who acted while it was still cheap. Here is the part most folks never learn. You do not have to cash out your retirement and pay a tax bill to act on that. If you have $100,000 or more in a retirement account, a 401k, or an IRA, you can move a portion of it into physical gold and silver inside that same account, with no taxes and no penalties, through what is called a self-directed precious metals IRA. We put together a free guide that walks through exactly how that works. It is called the Retirement Wealth Protection Guide. If you are watching this on your TV, just scan the QR code on your screen. If you are on your phone or your computer, go to readfamilyguide.com. This is not just for insiders. If you have that $100,000 or more in any retirement account, this is for you. From our family to yours. No obligation, nothing to buy. Now, let me stay on that ratio for a minute, because silver adds a second, sharper edge to the whole story. Silver is not just money, it is a working industrial metal, and most of it does not even come out of the ground on its own. It comes up as a byproduct when miners are digging for copper and zinc and lead, which means the world cannot simply flip a switch and produce more of it when demand jumps. On top of that, the market has run a genuine supply deficit for several years running, using up more than it digs up, drawing down the stockpiles that sat above ground. And unlike gold, which gets hoarded and treasured and passed down, silver gets consumed and scattered into a million products where it is too thin and too cheap to ever recycle back out. The old lime captures it well enough. Gold is saved, silver is used up. A tightening supply meeting a stretched ratio is the kind of setup that does not stay quiet forever. Let me be honest with you though, because a host who only tells you the bullish side is not a host you should trust. This is a case, not a promise, and I am not going to insult you by pretending I know the timing. Metal does not move in a straight line. When conflict looks likely, gold prices in a fear premium, and when tensions cool off, that premium bleeds right back out and the price can slide even when nothing fundamental has changed. We have seen exactly that kind of de-escalation lately, some safe haven air coming out of the market. There will be sharp pullbacks. There will be stretches where the managed price looks like it is winning and the doubters look smart. That is how these things always go before they break. If you cannot sit through a shakeout without panic selling into it, you are the trading desk's favorite customer. Size your position so a dip can never force your hand. That honesty is the whole point. I would rather you understand the risk than chase you into anything. Now watch what happens when you add the money printers to this picture, because this is where it gets genuinely serious. The people who set interest rates are divided right now, some of them openly talking about tightening the screws to fight an inflation that has run above their own target for years. But history tells you which way that fight usually breaks. Back in the early 1950s, there was an accord that quietly pinned government bond yields for about a decade to make it easier to carry a mountain of wartime debt. That is called fiscal dominance, when the debt gets so large that keeping it affordable matters more than defending the currency. Later, one chairman flinched at an oil shock and let inflation run. It took a different, iron willed chairman, willing to push rates into the high teens and break the economy, to finally wrestle gold back down for 2 decades. Ask yourself honestly, with the debt where it sits today, does anyone believe there is the political stomach for that kind of medicine again? When they cannot raise rates enough to defend the money, the value side of the vice wins. Every time. And do not tell yourself that a government cannot simply reach in and change the value of your money by decree, because it has happened right here on American soil. In the middle of the last century, before that fixed post-war system, our own government revalued the dollar against gold overnight, cutting the buying power of the dollar in one stroke. And just before it did, it made it illegal for ordinary Americans to even own gold, forcing citizens to hand their coins in at the old price. I am not telling you that to frighten you. I am telling you so you understand the deepest reason the metal matters. The price of your paper money is a decision other people get to make, and the price of an ounce of gold is not. That is the difference between an asset you truly own and a promise you are merely holding. Think for a moment about what a bank deposit really is, because most people never do. When you leave your dollars in a bank, that money is not sitting in a drawer with your name on it. It has become a loan to the bank, an IOU, a liability on their books. We got a sharp reminder of that not long ago when a run tore through a stretch of regional banks and depositors suddenly learned how fragile that promise can be. And overseas, the lesson has been far harsher. Savers in places like Turkey and Lebanon this past decade watched their deposits get trapped behind bank doors or simply vaporize in real terms while they stood helpless. Those people did everything right too. They saved, they trusted, and the counterparty failed them. Gold is the one form of savings with no counterparty at all. It does not need anyone else to keep their word. That is precisely why the vault keepers of the world are quietly loading up on it. And here is a piece that almost nobody connected until recently, but it changed the game underneath all of it. A few years ago, a major power had its currency reserves frozen in a geopolitical dispute. Overnight, every central bank on Earth learned a lesson they will never unlearn. The dollars and bonds you hold in someone else's system can be switched off with a keystroke. But gold, sitting in your own vault, cannot be frozen, cannot be canceled, cannot be voted away. It has no counterparty and no politics. That single event lit a fire under official gold buying, and it is a big part of why gold recently passed the moment where it became the second largest reserve asset held by central banks, ahead of other major currencies, sitting behind only the dollar itself. The people who manage the world's money are voting with their vaults, and they are voting for the metal. Let me put the two jaws together now, so you feel the full weight of it. On one side, the true value of gold keeps rising, driven by money that keeps getting printed, by central banks that keep buying, by a world that no longer fully trusts paper it does not control. On the other side, the ability to hold the price down keeps thinning, as real metal drains out of the vaults and paper promises pile up on top of a shrinking pile of the real thing. Rising value, falling defense. That is not a coincidence, and it is not a temporary imbalance. It is the exact configuration that broke the post-war system, and it is forming again in plain sight, while the mainstream calls gold overbought and tells you to wait. Which brings me to the thing I most want you to hear before we finish. The smart money is not waiting. The central banks are not waiting. They already made their move. They are already positioned. And they did it quietly, the way real accumulation always happens, without a headline. The crowd has not turned yet. The pension committees and the financial talking heads are still treating this as a fringe idea. And by the time it becomes the obvious trade, by the time every advisor on television is finally telling their clients to own some, the patient part of this will already be behind us. Being early does not feel like being early. It feels like standing in a quiet room while everyone else insists nothing is happening. That quiet is the opportunity. It does not last. So what do you actually do with what you own? Not a prescription, just the principles I have watched serve people well. Own the real metal, not a paper claim on it, because in a squeeze, the paper is exactly what fails. Size it so that a shakeout, and there will be shakeouts, can never force you to sell at the bottom. Do not try to time the perfect day, because nobody rings a bell and the day is unknowable. Think of it as insurance on the purchasing power you spent a lifetime building, not as a lottery ticket. That retired nurse in Missouri did not need to get rich. She just needed a piece of her savings to sit in something that could not be quietly diluted while she slept. That is the whole game. Which is exactly why I want to leave you with this. That free retirement wealth protection guide is not only about protecting what you built, it is about the legacy underneath it, the part of your savings that one day becomes what your children and your grandchildren inherit. Diversifying a portion of it into physical gold and silver inside the retirement account you already have is about making sure that what you spent a lifetime earning survives long enough to become theirs. And for those of you with $100,000 or more who watch all the way to the end here, we also offer a free one-on-one educational web conference, no cost and no obligation if you mention you saw this video. There is no fake deadline on this, and I would never insult you with one. Be honest, why now is simpler than that. The window where this decision is still cheap, still calm, and still fully reversible is exactly the window when nothing feels urgent. That window is open right now. If you are watching on your TV, scan the QR code on your screen. If you are on your phone or your computer, go to readfamilyguide.com. From our family to yours. Because remember how this started. 8 governments once stood together and swore they could hold the price of gold in place forever. They had the treasuries, the coordination, the full authority of the post-war world. And still the metal drained away. Still the peg broke. Still the temporary measure became permanent. And the savers who held the real thing were the ones left standing. The same two-sided vice is closing again today. The only real question is which side of it you want to be on when it finally snaps.